Welcome to the Win, Make, Give Wealth Series Part
2.0.
Ish. This is Ben Kinney. I'm joined with Bob Stewart.
Ben, how you doing?
Chad Himes.
Hola.
And Dave Weldon, the guy that never says anything.
No, but you did do a good Dave Weldon impersonation in the last episode.
Hi, everybody. I am so excited to be at the next part of the Wealth Series.
Now, folks, he really is excited, even though it didn't really sound all that exciting. You got to know, Ben's really excited on this.
This is my excited voice.
Yes, I can tell.
We spent nearly an hour on the last part diving into financial instruments.
Yes.
And it was kind of an intro to financial instruments, like what is a stock, what is a mutual fund, what is a bond, how do they work, 401ks, retirement accounts, what are the limits, just kind of getting our mindset in the right spot, because we have people that are advanced and super far into their wealth journey.
Yep.
And we have people that are 15 years old and are just starting to think about it, or people that have not focused on this and they're 30 years old and they're trying to think about, how do I get on track? Or
I don't know how many years it took me to just learn the difference between one from the other, and I'm still attempting to figure it out. Ben.
Yeah, I mean, Chad's 64 years into his life,
Wait a
and
minute.
he is all of a sudden now just trying to say, I need to get on top of this wealth journey. Well, I had many people request, like, how can we dive into some more advanced topics? So I'm going to call this a bonus session, but it's not really, because it's part of the Wealth Series.
Yes.
And today we are going to dive in to advanced strategies of wealth building through financial instruments, stock market related things.
Okay.
And we are going to interview my personal financial planner. Her name is Molly. She is phenomenal. She's from Goldman Sachs Wealth Management. And she has helped me learn, understand, and take advantage, yes, of some strategies that honestly I'd never heard of before. So I'm really, really excited to dive in to the nuts and bolts and to some of the strategies that Molly uses for her kind of entry-level client like me.
Yep.
And then some of the clients that her department and her team manage that are, you know, multi-billionaires with their pinky up in the air.
And Bob, we'll make sure one of us jumps in during this interview just to make sure that
to play the everyman, right?
Right,
to bring
right.
it down to a level that everybody can understand.
Okay, so we'll make sure one of us takes over there and brings that conversation back to everybody else.
You're going to walk away from this interview asking yourself a question: do I need a financial planner, or should I do it on my own? And there isn't an answer to that. It's an individual answer based on what we learned. You're going to walk away thinking, is the financial planners or the advice that I've been getting, have they been missing some things or leaving some things out? And you're going to be truly blown away. So ladies and gentlemen, please join me in virtually welcoming Miss Molly English. It's really exciting, Chad, to have an opportunity to introduce our audience to somebody that personally helps me with my retirement planning and my wealth strategies. And if you think of an organization in the world that manages money and understands finances, there's few names that you wouldn't have to ask for very many names on what Family Feud or whatever that shows would be, Chad, before somebody said, well, Goldman Sachs. Well,
yes.
Goldman Sachs, an investment bank, a bank, they do an enormous amount of things, but they also have this division of wealth management, and they have financial advisors, and they have financial advisors and online tools for the entry-level person that's just getting into their retirement planning, wealth management, and they have teams that work with super wealthy people that I couldn't even imagine being. And I'm lucky enough today to have Molly English on the call with us. And Molly, I'll let everybody you tell them what your title is and maybe a little bit about what you do. And we're going to dive into some advanced strategies for investing and some of Molly's perspectives on investing in general and why we should invest, and maybe even the behavioral sides of investing. We'll go through a whole bunch of topics. Super excited for you to join Chad, Bob, and myself for the Wealth Series. Molly, tell us who you are and what you do.
First, Thank you so much for having me, Ben and Chad. Very, very excited to be here. I work as a private wealth advisor at Goldman Sachs. I am based in the Seattle office. So we have 12 regional offices outside of our New York headquarters, about 500 advisors across the country. I work with a small number of individuals and families in managing all parts of their wealth picture. And so what that looks like is primarily investment management, so managing the investment portfolio, but also supporting them across all elements of their wealth picture. So trust and estate planning, lending, charitable giving. If they have an up at night moment and think, oh no, am I spending too much this year? They give me a call. So I'm really sort of a one-stop shop in that respect. And then I coordinate and work closely with my clients' other advisors. So I work very closely with their CPA, their trust and estate attorney, sometimes their insurance advisor. Often those folks have a lot more clients than I do. Like I said, I work with a very small number of clients to enable me to be very proactive and strategic and manage that holistic wealth picture. So I'll sort of serve as the quarterback in working with the other advisors of my client.
Love that. And we're a very transparent world. So if I ask you questions about my strategies or what I'm doing or any of that, Molly, feel free to share. Like, we'll keep our secrets limited to the 1 million+ downloads of the When They Give podcast. Goldman Sachs has departments that work in all different ranges of people's annual incomes. Is there anything you would add to that, or the names of those different departments or organizations that do that for people that want to explore?
It's a great question. I don't think the names matter as much. I think you hit the nail on the head. We can support folks across a wide range of investable assets. At my group, we work with folks who have a minimum of $10 million of investable assets. Right. There is a group at the firm that works with folks more in the maybe 500K to 10 space. Okay. And then for folks perhaps a little bit lower than that, we have Marcus Invest, which is essentially like a robo advisor platform. That said, I'd like to open myself up. If folks ever have questions, they should feel free to ping me. You don't need to be a client. If you're a friend of Ben Kinney, then I'm happy to help you out.
Careful, because everybody's now a friend of Ben Kinney.
Yeah,
that's true. I witnessed this in September. I didn't know he was such a celebrity. Now I do.
I'm like a C.
Got to get his autograph.
If you want a free ride on a bus, like a 35 cents worth of value, like I'm your guy. A Marcus Invest, like, could somebody go there and set up a 401k or an IRA or start making those types of investments?
To be honest, I'm not sure about that, Ben.
Awesome. So let's
skip that one.
Let's take a more generic approach to this conversation. What is the role of a financial advisor, and how would you go about selecting one if you were listening to this podcast? Like, what kind of questions would you ask them, or what would you want to know, or would you advise certain people to do things on their own? That would be something that pops in my mind.
Yeah, no, that's a great question. I think the biggest benefit of having an advisor is the peace of mind that you get from having an advisor. You have so much going on in your life with work and family and life that it's helpful to offload the stress of your finances and your investments onto somebody else and pay them to, quote unquote, worry about it and to think about it. So I think that is the singular most important reason to have an advisor. When you think about having an advisor, what stands out to me as the most important thing before you think about anything else is there chemistry with this person? And the reason that's important is if there isn't chemistry, then you're probably not going to like that person very much. And then you're probably not going to trust them very much. And if you don't trust them, then you're not getting that peace of mind. So that piece is critical, super subjective, qualitative. You'll know it when you meet them. The next thing that I think is very important is communication style and level of responsiveness. And so if you're interviewing different advisors, I think a very fair question to ask is, how long should I expect on average to go by before I get a response? Because this isn't your Xfinity subscription. Like this is really important. This is one of the most important things in your life, outside of your family and friends and people you care about, and your health. And so I like to say 24 hours at the max. I think for the longest response time, though I will say, I really think it should be within a few hours. I say that 24-hour piece in case somebody is stuck or stranded without Wi-Fi. But otherwise, you want to know that you can get access to your advisor if you need them. Another question that I would ask is, what's the plan when they go on vacation? Are you working with their team? Are there other folks on their team? Are there analysts? Are there other advisors? Or is it possible that they'll also just continue to be responsive when they're on vacation? Because a lot of times if you have a question, and it's an urgent one. The next thing that I would ask is, what types of services and resources do they offer? And so are they able to be helpful with trust and estate planning, taxes? Do they have a lending arm? Is there somebody on staff who can help you think through charitable giving or giving through a donor advised fund? Figuring out if that's something that's offered in-house. And if not, do they have relationships outside the firm where they'll introduce you, and what do the fees look like in those cases? And then the last thing that I'll say here for people who are thinking about hiring an advisor is ask a friend. I don't get my haircut without talking to somebody first who has seen this person.
Neither do I, Molly. I don't.
I can tell Chad, he or she is doing a phenomenal job. They need to keep doing what they're doing. So yeah, I think it goes a really long way. If you have a friend who's in a similar situation to you, talk to them, ask them if there's somebody that they like and if they're willing to make an introduction.
I love that list. Chemistry, communication, and response times. How's your backup if that person's gone? What are the different services and resources do they provide? Like, can they help you with trust, taxes, lending, charity, so on? And then also, when selecting one, try to get a referral before you just randomly go to someplace without checking. We talk about ways for people to manage their retirement without an advisor by just going to Vanguard and setting up a 401k and
Sure.
HSAs and that kind of stuff. But if they were to work with an advisor, and we're talking about the average American that's planning for a retirement at 65 or 70 or whatever that is, Molly, what do you think they should expect in fees in your mind? Like, what do you think that would be?
It's a good question. So the way that I think about it is that the larger the amount of assets under management, the more compressed the fee will be. There's economies of scale there. Yep. So it's hard to sort of ballpark, but if we were to say $1 million of investable assets, I think it's reasonable to expect 1%, perhaps a little over 1%. And I will say, when you bring up fees, prospective clients should always ask the advisor to see all layers of the fee. So there's typically an advisory fee, and then there are expense ratios that are associated with third-party managers. There's some advisors out there who will not show that third-party fee, and they chalk it up to the fact that, well, it's the same fee everywhere, so I don't need to show it. But if you're paying it, you want to know what it is. And so there'll also sometimes be a custody fee. And then in your first year, your first couple of years of becoming a client, there might be a de minimis amount of commissions. but you want to get an understanding of that holistic fee picture.
The first couple of times I met financial advisors, they were not your caliber, Molly. I sat down and like the first thing they handed me was a pamphlet on whole life insurance or life insurance. And what I realized over time was there are certain products that people pitch that has enormous commissions for the financial advisor. And I just, over time, I just said, is this something that you get commission on? And if the very first things they're talking to you about are things they make a lot of commission on, like life insurance, you should probably walk out of the room and find somebody else.
That's exactly right.
I think we've also, as I got to know you as a financial advisor, the first, majority of time that we spent together was you getting to know me as a human and me as my goals and me and my businesses and what I do before you ever suggested anything. And you help work with another close friend of mine. And what you advised to him is different than what you advised to me, because I think in your words, when we met for breakfast last week, was you're a more conservative, pessimistic type of investor. Like I'm a world is ending zombie apocalypse type of person. So
I love his house. It is. He's ready for it.
Yeah. Thanks, Dad. I love these first couple comments about picking a financial advisor, but let's go a little bit back into the basics for a second. In your own words, Molly, what is investing and why invest? You've explained this to me a few times as the 4 different places money could go, but let's let everybody hear it from Molly English from Goldman Sachs instead of me butchering what you say.
Well, I understand you've already kind of gone over some of the basics, so some of this might be redundant, but
it's okay.
It's at the very core, investing is the act of putting money to work with the expectation that it will grow over time. And so there's, of course, real estate investing, which I know is close to your heart. And my line of business, we're looking at stocks and bonds. And once you're invested through the power of compounding, which we can talk more about, a relatively small amount of money can grow pretty substantially over time. And we could spend an entire episode talking about the different reasons why people want more money. I'll talk about a few. One is inflation. It's extremely top of mind right now. I imagine every listener has felt it. Inflation makes things more expensive. It erodes purchasing power. I swear I go to the grocery store and I get milk and eggs and a loaf of bread, and that's $125. And so when you invest and grow your money, you are offsetting that purchase power erosion. A second reason to invest, and I have to credit our friend Morgan Housel, when you have more money, you have more control over your time, and having more control over your time makes us happier people, full stop. A good example of this is retirement. So ideally, you're saving and you're investing for retirement in a way that when the time comes, you have complete control over your time for the next 20, 30 years, and ideally are able to continue living your desired lifestyle. And then the last thing that I'll say, Ben, and yes, you and I have talked about this a few times, it's the 4 places that money can go. And I have to credit my friend and my mentor, Mike Guyton, with this framework. Money can go 4 places. You can spend it. You can give it away to people you care about. You can give it away to charity, or it can go to the government in the form of taxes. And it is your advisor's job, my job, to help you optimize for those first 3 and to minimize the 4th. And a big part of that optimization is maximization through investing.
So did I hear, if I got those correct, the 4 places, obviously number 4 was the government, and I'm glad you put them number 4, right? Our goal is not to give them as much as possible and do what we want with it. And that's a message we'll hear again from Tom Wheelwright when he talks with us about taxes, I'm sure. The first area was what, Molly?
Spend it.
Spending.
Spend it, right? We all like to spend money.
And that, Chad, is the most important bucket, because you need to know that you have enough in perpetuity to spend how you want to spend. As an advisor, that's always what I'm thinking about first. We're not even going to think about, talk about giving money away to people you care about or giving it away to charity until we know that there is enough in your, what we call quote unquote, lifetime spending endowment. And then once we know that bucket is satisfied, then we can talk about giving away to people you care about and giving away to charity.
And then giving away to charity. And Molly, as Ben's advisor, because I know you work with it, I just want to make sure my name ends up in bucket 2.
You got okay,
it. I'm gonna write just make sure, just so you know, when you and Ben are working on strategies, just make sure, right, Chad's in bucket 2 there. Okay.
Well, Chad,
top of the agenda.
Chad, you and I have spent the vast majority of our lives maximizing number 1 and number 4, which is spending the money we make and giving the money to the IRS. And in the last couple of years, we've been learning how to spend a little less, give away to people, save for retirement, and minimize the amount we pay in taxes, which we'll talk about in the upcoming episodes of the Wealth series about taxes. Molly, let's keep going. This last year, well, let's go back. In 2020 and 2021, I was the world's greatest investor. I outperformed every index that you could ever imagine. I bought things like AMC, killed it on the movie theater business before people even thought it was cool. I'm like, hey, when COVID gets over, well, I'm going to go back to the movies. I should own movie stocks. I killed it. I bought a vaccine stock on accident once for 53 cents one night, and it ended up selling for $180 a share. Like, I was the world's greatest investor. But last year, not everybody in the world was a genius. And we came down to, there are volatile times. And as Molly's worked with me through the last year or two of me feeling like I'm no longer a genius, she has to convince me, hey, it's sometimes when things are uncertain or volatile, you need to keep investing. And if you could give us some advice on why people should invest during these volatile times, that would be great for our audience to hear. Because I think they looked at their 401k and say, my 401k is less last year than maybe what it started. And now they're worried and they don't want to do anything else for it.
Totally.
But walk us through that.
Yeah. First, I'll just validate what you're saying, which is 100%. It has been a very volatile and tumultuous time. Certainly the most tumultuous time that I've seen in my career, and something that we haven't experienced in 15 years. So people should feel like they're in good company to feel uneasy or uncertain about whether or not to stay, to get out, to invest more. But the data shows that timing the market is really a losing strategy. And even though it's painful right now, which it is sort of universally, if you stay the course with your strategic asset allocation, it pays off. And I'll illustrate with some data from our investment strategy group. So this data is from June, but if we go back to 1992, so 30 years ago, and we think about everything that happened in the last 30 years. So you had the dot-com crash, you had 9/11, you had the financial crisis of 2008, you had COVID, really, really big, monumental events that, would have been tempting to bail out of the market at any one of those points. And a lot of people did. But despite all of that, the S&P 500 still returned over 1,600%. So
did you just say 1,600%, Molly?
That's right. 1,600%.
Wow.
In that 30 years. Now, it won't surprise you that the best days and the worst days typically happen very closely to each other. And so our investment strategy group played this out. And you see, if you had invested $1 in 1992, today you'd have over $16. Or to make it more exciting, you invested $1 million, you'd have over $16 million just by putting it into the S&P 500. If you missed the best 10 days out of that 30-year window, instead of having $16, you'd have $7 and change. So less than half that.
Wow.
And if you missed the best 50 days, you'd have $1 and change. So you'd be almost flat.
So those who decide to time the market and pull in and pull out, they run into this problem that their returns go from 1,600% down to nominal, almost nothing. Is that what you're saying?
That's right. I mean, I'll say if you're missing some of the best days, perhaps you're missing some of the worst days. But what ends up happening then is when you're exiting and entering the market, chances are there's a little bit of a tax liability or consequence, right? On your way out, you're likely paying some capital gains. And then by the time you decide to go back in, like you're finally comfortable, you feel like things have recovered, the market's more expensive now. And so you're absolutely eating away at those returns. Now, for the people who think, well, the best days and the worst days, maybe like I'd rather miss the worst days. If you look at data back to 1957, so 66 years of data, 51 of those years have ended the year with a positive return. So over 77% of the years. And 38 of those years have ended with a return in the double digits.
So basically summing it up, Molly, don't sell unless you really need it because you're better off letting it ride out and play.
That's exactly right. It's not as simple as a buy and hold strategy. Your advisor should be rebalancing, perhaps introducing different strategies that make sense depending on your situation. But at the end of the day, when you're a long-term investor and not a day trader, which they're very, very different mandates, and likely the people who are listening right now are thinking about being long-term investors and not day traders. When you're a long-term investor, you enable compounding to happen, which is the most powerful force for wealth creation.
The eighth wonder of the world, I think, is how we...
That's right. I like that. And so that is when, the process in which the returns on an investment are reinvested to generate additional returns. And compounding is kind of funny because it's easy, but it's not easy at the same time. People find it very hard not to act. When things are going wrong, they want to do something. It's human nature. And so they want to buy, they want to sell. When chances are those people who are doing that are going to end up doing worse than their peers who are staying in the market, riding the market. And additionally, and in this day of instant gratification, where you can watch an entire series on Netflix over a weekend or get a package delivered the same day, waiting for compounding to happen doesn't feel very exciting or satisfying. But if you let it happen, you'll see that it really is the most impactful investment strategy out there.
Okay. And folks, if you are jumping into the Wealth Series today, like for some reason you didn't go back to episode 1 and you just picked up the Win, Make, Give podcast today and you're hearing Molly talk about this, at least go back to episode 6 of the Wealth Series, which is episode 60 for season 3, because that's about 45-minute conversation about compounding and how it works. Perfect. And how this gets you where you're going. Ben really breaks down one of the most complicated yet powerful financial tools out there.
Let's talk about diversification, and let's kind of do an overview of what that means for the audience and then what you advise, Molly. And then we could even talk about my percentage mix of where I'm at. And then maybe you compare that to some of your other clients without using names. But let's start with diversification, because that, in my mind, that is a way to protect us from the ups and downs and to minimize the scaries of investing.
That's perfectly put. So diversification is like the age-old expression, don't put all of your eggs in one basket. And on the investment side of things, diversification is when you are investing in different asset classes that benefit from different sources of return. And so you're spreading out your risk in order to achieve steadier returns. And Goldman has a phenomenal slide that illustrates the importance of this. And what it does is it goes back 10 years. It looks at the last 10 years by year and examines 11 different asset classes. And each asset class has its own colorful box. And so when you look at the slide, it looks like just this colorful quilt Because what you see is an asset class might be at the very top. It was the highest performing asset class that year. And then the next year, it's second from the bottom, and then it's hopping all around. So you'll see emerging markets, top of the list in 2012, second from the bottom in 2013. REITs, top of the list in 2021, second from the bottom in 2022. And so what this shows you is that you really want to have exposure to almost all of these asset classes so that you're able to, again, spread out that risk and steady out your return profile.
Can we see that
Yeah.
image? Can we share that with the Well Series people? Is that
absolutely? I can share that with you.
Have? Okay, cool.
That's definitely something that you can have.
Chad was texting me behind the scenes like, "Hey, can we share that with the listeners?" I'm like, "Well, I'll ask."
Yeah, you got it.
Cool.
For sure.
Check the workbook, folks. If you're listening, it's in there.
It will be.
It will be. By the time this goes, it'll be.
Yes. Perfect.
Okay. Diversification. Keep going.
So that's what I'll say about diversification when it comes to client portfolios. And again, everybody's situation is different. My clients tend to have a different situation than perhaps another group's clients. But you want to have at the very least, a good mix of fixed income and equities. Now, you probably covered this in your last conversation. Fixed income is a fancy word for bonds. Equities are a fancy word for stocks. When you hear somebody talk about a 60-40 portfolio or a 70-30 portfolio, stocks or equities are always that first number. So 60% stocks, 40% bonds. So at a minimum, you want to have the right balance there. And again, your advisor can help you figure out what makes sense. And again, spend and retirement is a big part of that. Within fixed income, bonds are not incredibly exciting. They don't really exist to drive returns. They're there to dampen the volatility in the portfolio. We had a really weird year last year. Now, it was one of the only times in history, 2% of the times since 1926 this has happened, where both bonds and stocks were down. Typically, there's a little bit more of a negative correlation, and you don't get hit as bad when there's so much volatility. And in 2008, people were very, very, very happy to have fixed income. And we maintain our conviction that we don't think this 2% is going to become the norm. We specifically like municipal bonds because they're tax exempt and also because they're less correlated to the stock market than, say, corporate bonds. So corporate bonds might have a place in the portfolio if you're looking to generate some additional income. On the equity side of things, we're split between US equity and non-US equity. Now, it is my bias in the US equity space not to be active. The US market is incredibly efficient, which means that it is incredibly difficult to beat it on a long-term, consistent basis. And so rather than beat them, join them. And so for my clients, they're invested in the Russell 3000 index, which is 98% of the market. You're getting exposure to energy, real estate, small cap stocks. And then we apply a tax loss harvesting overlay. And we can talk about that more later, Ben. And then on the non-US equity side, the market is a little bit less efficient. And so we think there are ways to achieve alpha beyond the MSCI EAFE, which is the non-US benchmark, essentially the S&P 500 in the non-US space. And so in those situations, we'll look to employ active management, which requires a bit more in fee dollars, but we think is worth it. And then depending on the client, once that portfolio is fully implemented, we might look to build out a private equity program. And private equity is a little bit different in that it is illiquid. You're locking your money up for a long period of time. But the idea is with that liquidity risk comes a return premium in excess of what the public equity markets are doing. Now, Ben, you said I could talk about your personal situation, and I will. Ben is incredibly conservative. He is what at Goldman, we have 3 money minds, which I can talk more about. There's commitment, happiness, and protection. Ben is a protection money mind. He is preparing for the worst case. And I think saying zombies is perfect in describing that. And so Ben has a very, very conservative portfolio. He's actually more at a 30-70 rather than a 70-30. And one of the reasons
stocks and 70%
that's right.
cash or
fixed income.
Fixed income.
That's right. Now, that will change over time as Ben gets more comfortable. But we are in uncertain times. And so if this is what helps Ben sleep at night, then it is the right answer for Ben.
Ben never sleeps at night. It doesn't matter, Molly. Do we find that kind of, I mean, Ben's just conservative in that regard and preparing and the zombie apocalypse and all that. Yet is that also similar to somebody who's maybe closer to retirement age, that should be the mindset they should be taking because they have less time to play around and play games with this opportunity? Yeah,
it's a great question. The main thing that I think about in terms of what makes sense in that equity fixed income split is the portfolio supporting their spend appropriately? And so I imagine you may have talked about the 3% or the 4% rule before. Okay.
Yep.
So typically a 60-40 portfolio is going to enable you to spend 3% of the portfolio into perpetuity without dipping into the principal. And so if somebody was coming upon retirement and they had more than enough to satisfy their spending needs, in my mind, there's absolutely no reason to dial up risk if we're already achieving our goals. And that is why a 30-70 portfolio is totally fine for Ben, because he's okay. He's not getting to a place where he's going to run out of money and not be able to spend what he wants. Now, I do have clients where that is a consideration, and I have to show them, if you keep spending to this degree, and I show them a wealth illustration, in 18 years, you're going to be at zero because the spend is surpassing the amount that the portfolio can support in terms of its return.
Got it.
So if we were to think about my long-term strategy, because I am pessimistic about the short-term state of the economy, I'm very bullish on what the world looks like in 18 months or 24 months or so on. I just have a belief that this year is going to have some ups and downs, and I might be wrong. You never know. But we have a long-term goal, Molly, of being invested in private equity, equities, fixed income, and cash. Where do you think, let's say in 5 years or 10 years, if we're successful, where do you think I end up at as a percentage in each one of those buckets? And if you were coaching or controlling, which you really do, my investment, like where do you think we end up?
I think a 60-40 is the right place for you.
60% fixed income.
60% equities.
Equity. Stocks always
equities.
First. Equity
so
first.
Thanks, Chad.
Yep.
Equities, 40% bonds
Fixed
or cash.
income.
But we have a 15% private equity goal that you talked about. Is that part of the equities bucket?
That's exactly right. Yep. So, right. So you would have 45% public equity, 15% private equity.
Okay. And then, 45% stocks, 15% privite equity. And then of the 40%, I keep a fair amount in cash. Do you think that over time that goes away and it's all 40% bonds, or do you think some of it stays cash?
I think part of that Yes, I think realistically, 5 years from now, we're looking at entirely fixed income, depending on what your cash needs are. And so there might be cash flow conversations that we have, and it just makes sense to have a small amount set aside in cash. We're in such a unique time right now that the yield on cash is what it is. That is not normal. And so cash is outperforming bonds in some cases right now, but that is utterly temporary.
Yeah.
And so instead of staying on the sidelines and trying to take advantage of what is sort of a one-off situation, it will make much more sense to continue to build out your fixed income exposure.
Got it. So we are deep into this podcast, and I told them that we would talk about some specific, more advanced strategies that maybe their advisors or their friends or their books don't talk about. Like every book I read says, put your money into a retirement account and invest in the S&P 500 and put it in an index fund and just leave it. And for the vast majority of the world, that's a great strategy. It's going to outperform people that are trying to time the market or pick stocks individually. They're going to win. And so I like that. However,
yes,
there are some things, if you have a little bit more cash to invest or you want to learn about, that we could talk about a few different strategies. One we mentioned kind of on the side, which is investing in private equity. So you could ask your advisor if they have opportunities through them to invest in private equity, which private equity are companies like Tiger Global and Goldman Sachs and like people that buy and invest in businesses themselves. So you could be a part of, Uber or whatever these companies that they invest in over time. That's before they go.
So basically what you're saying in that situation is I'm giving you money, Molly, and saying, hey, put this into whatever Goldman Sachs is about to go buy. I want a piece of whatever company they're about to support. That's not on the open stock market or things like that. So I couldn't get ownership or commitment to it any other way.
That's exactly right. Yep. And so Goldman's platform specifically, we have core funds at Goldman. So Goldman private equity funds, but we also have access funds to, like Ben mentioned, Tiger Global, NEA, TCV, those types of places.
Yeah. So the first advanced strategy you could talk to your planner about is, do they have an opportunity to invest in private equity? But I want to go into a more fun one that you mentioned already, and it's called loss harvesting. And Molly, let's take a swing at explaining what that is and why it's beneficial.
Yeah, for sure. So a great part, the best part of investing is making more money. The less fun part is paying taxes on the appreciation of your investments. And so tax loss harvesting is a strategy that you can employ to help offset some of that capital gain recognition. And I'll get pretty granular if you'd like me to in describing how we do it at Goldman.
Let's start with a simple description that I've been using of, if I was to buy Pepsi at $10 and I was to sell Pepsi at $20, that I would have to pay income tax on the difference between 10 and $20. True, Molly?
Capital
gains tax. Thank you.
Yes.
However, if I bought Pepsi at $10 and it dropped to $5 and I sold it, I could realize the loss, that $5 loss per share, so long as I sell it and I don't rebuy that same exact stock for 30 days. Correct. Okay. Now, tell me how that relates to what you and Goldman do for the advanced strategy called tax loss harvesting.
So I think you just made a really important point, Ben, which is that people can do this themselves. You don't need to necessarily participate in a tax loss harvesting strategy, though I would recommend it. But if you have a number of single stocks and you see that one is experiencing a loss and you are potentially worried about your capital gains bill, you can sell it and plan to rebuy it again after 30 days so you don't experience wash sale issues. Now,
December 8th or 29th this year, I sold every junk thing that I owned that had gone down in value below what I had paid for it in my private personal stock account. Now, in my investment account, Molly, that's what you do for me on a regular monthly, weekly, daily basis. You manage that for me, but I have my own buy Tesla, buy junk stock.
The Ben Kinney hedge fund.
Yes, that's right. I'm trying to outperform everybody else with my crazy ideas. So, okay, keep going.
So the way that we'll do it is we build out a custom index for our clients that tracks a benchmark. So it'll track the S&P 500 or it'll track the Russell 3000. And it's a separately managed account, meaning that you own the securities directly, which is different than, say, an ETF. So you own the securities directly and you're owning about half of them. So 250 if you're tracking against the S&P 500, about 1,500 if you're tracking against the Russell 3000. And the team is getting it to a very close tracking error of both of the respective indexes, such that when a stock experiences a loss, the team will go in, sell it, recognize that loss, and then replace it with a stock of similar style and sector characteristics. So to use your Pepsi example, selling Pepsi and buying Coke, or you're a car guy selling GM and buying Ford. So that at the end of the year, you've maintained roughly, again, so within a small tracking error, you've maintained roughly the same performance as the market, the S&P 500 or the Russell 3000, but you have these additional losses that you've harvested that you can then use to offset gains that would otherwise erode your returns. And we call that tax alpha. And Ben, we talked about this a couple of weeks ago. You had like over 6% of tax alpha this past year. Now, granted, I told you this, that's not going to happen every year. It was a crazy year. It was a very volatile year, but that's over 6% of outperformance. That's phenomenal. And the thing about what people need to know about harvested losses is that you can use them in that current year, or you can use them in perpetuity in subsequent years if you don't use them that year. And they can be used to offset gains, whether it's an investment gain, or if you sell a property, or if you sell a business. They can be used in a number of ways. So a very compelling strategy.
In a normal market, unlike last year, you might get your average S&P return of 11 or 13%. Plus, by selling your losers, you might end up with 2%, 3%, 4%, 5% additional wins because you also get to take losses on the ones that went bad. And you combined overall through the year, you actually have a better return than those people that just stayed in the market.
That's right. Yep.
So there is a time where selling a stock does make sense for your strategy, and not just buy, hold, and say, well, I'm going to hold this fictional Pepsi stock. I wouldn't buy them. I can't drink that stuff. But buying that Pepsi stock and just saying, well, I'm just going to hold it because sooner or later Pepsi will turn around. There is a strategy in there, Molly, that says there is a point where selling it does make sense. You can always buy back in 31 days later if you really believe in Pepsi, but that gives you that loss to be able to offset your gains.
That's
exactly right.
What Molly taught me, Chad, was when she showed me the charts, when the stock drops 500 points or 1,000 points, the stock market drops that day. Yep. It's very common for it to rebound the next day, the next week, or within a short period of time. So when you sell it and you stay out of the market for 30 days, you end up missing the bounce back up. Right. But by owning Delta and selling it when the whole stock market crashes, and buying Alaska the next day, you're able to stay in the market, but still take advantage of the losses. And so, Molly, if we went to our financial planner and said, what are some advanced strategies that you offer your clients? One of the things they might mention is tax loss harvesting tied to an index fund like the Russell 3000 or the S&P 500.
Exactly. Yep.
And if they don't, we should wonder why.
I think so. Tax loss harvesting is on most of the big platforms out there. It's not an exclusive offering. So I think it's a good question to ask. And if it's not there, why? Absolutely, Chad.
You and I had breakfast the other day, and we sat down, and you were talking to me about another strategy called Beta Plus. Correct?
Yes.
Why don't you tell us what that looks like, or explain that, and then they can go do their own research. We don't have to get too scientific, but take a swing at it.
Sure. Yeah. So Beta Plus is the Goldman specific program. So we don't need to go too much into the weeds on that. But what it is it's a structured note strategy. And what a structured note strategy, and a lot of people will get intimidated as soon as they hear those two words, but it's really not too bad. It is a hybrid security that is a debt instrument tied to the performance of another asset. So what I talked to you about, Ben, was packaging a zero coupon bond with an equity underlier like the S&P 500. And when you do that, when you create that note, it creates a buffer on the downside in exchange for upside participation. And so I'll make it real. Let's just pull out some numbers. Let's say you got a structured note that had a 15% buffer on the downside with a max return of 16%. And let's say the note has a 15-month term. If at the end of that 15 months, the market did not go below 15%, you've got that 16% return. So if the market went down 8%, you've got that 16% return. Now, if the market went down 20%, you broke that buffer, but you're not down 20%. You're only down 5%. Now, the main trade-off, and this is why these were not very popular up until recently, is this whole notion of capped upside participation. So let's say the market rips to 30%, you're getting 16% because you have that cap. And so in the past, when we're thinking about the insane bull market that we had from 2009 to 2020, this strategy was a little bit of a performance drag. But ideally, if you are in a diversified, balanced portfolio, you're already getting exposure to the market. You're going to be seeing that 30% in another part of your portfolio. In your Russell 3000 tax loss harvesting strategy, you're going to see that. So you look at this more as a defensive strategy.
But you could get really wealthy over time, getting something like an annualized 16% return. Like, that's a life-changing annual return if you consistently got that with your money. So maybe it's not as good as it was in 2021 when we got 28 or 30% or 22 or whatever those returns are. It's still pretty good. That outperforms the S&P 500 over the last 30 years.
That's exactly right.
Okay.
That's right.
Is there cool? So the third strategy we would write down to ask people about would be structured note strategy. Ignore Beta Plus because that's the Goldman phrase for it. So if you work with Goldman, ask them about that. If you don't, then you're going to ask about structured note strategy. Is there anything else that comes out to you that you think is kind of cool and techie or new or advanced or interesting that people should add to their advanced wealth building strategies?
I think the one other thing that I'll mention is put writing.
Mm-hmm.
So, Chad, do you know anything about this?
No, you've been talking over my head for the last 15 minutes. I'm frantically taking notes. I'm going to be re-listening to this part again and again and again.
So put writing is really interesting right now. At Goldman, we have a put writing strategy for both market entry and yield enhancement. I really like it for market entry right now, given how volatile the market is. And essentially what it is it enables an investor to get paid on being patient and systematic in entering the market. And so what you're doing is you're selling a put option. So when you hear put writing is just a fancy word for selling. You're selling a put option and you're getting paid a premium on those puts. And what ends up happening is if the market is down below the strike price at the expiration of this option, then the client who has this put writing strategy has an obligation to buy X amount of shares at SPY at that higher strike price. And so let's say the strike price is 400. The market ends at 380. The client is buying at 400. Now, the alternative is that the market ends at 420 and the strike price is 400. Nothing happens, but the client collected that premium. And when I say premium, that's just the payment that they're getting on that put option. And so I mentioned you can do this for yield enhancement. You can do it for market entry. For yield enhancement, the quote unquote probability of exercise is a little bit lower because you're just doing it to collect that premium. You don't necessarily want to get put the market. But if you really do want to enter the market in a systematic way, you might have a higher probability of exercise. And what this ends up doing is ideally adding additional return to the strategy by year end.
I love it. So we have 4 advanced strategies: put writing, structured note strategy, tax loss harvesting, specifically tied to index funds, and potentially investing in private equity. We also learned how to pick a financial advisor, the different ways that money benefits us, the 4 places money could go. And then there was a young lady, just 14 years old, in the Win Make Give Facebook group, and her name is Ava. And she was reading a couple of wealth books, and she's in the wealth series. And I have to imagine that there's an Ava out there, a little Bobby, a little Benny, a little Chatty, and a little Molly that says, I want to be like Molly when I grow up. And what do you think the Molly level wealth strategy metrics is between men and women right now? Is it 50-50, 60-40, 70?
How many women?
Yeah.
Is your industry balanced?
Absolutely not.
Okay, so it's more men.
Yes.
Okay.
Yes.
And there's
it's getting. I will say it's getting better. Even I'd say the last 5 years, it's getting better. And Goldman actually has some really great diversity goals around its hiring to even that out. But yes, within the finance industry, it tends to be overweighted with men.
How long have you been in the industry?
About 6 or 7 years. And before that, I was in consulting.
Okay. And then what did you study in college?
I had, I was a business major, funny enough, with a marketing concentration.
Okay.
I did an internship at a marketing agency. It was amazing, but I learned that was not what I wanted to do. And I had a minor in Spanish.
Okay. So how'd you end up in finance?
So I spent a number of years in healthcare and higher ed consulting. I worked with amazing people across the US, CEOs of health systems, provosts of universities. I loved the client relationships. I loved helping them with their up at night issues. I got to the point where I knew, 1, I didn't necessarily want to do consulting anymore. And 2, I had just seen in my own family that there was this lack of understanding about finance. It just felt very opaque. And I would talk to other people and they just felt like it was very inaccessible, to the point that, like, I don't even want to talk about it when I talk to my advisor. Like, that's why I'm paying them. That, like, it feels off limits. And I felt like, gosh, it doesn't need to be this way. It doesn't need to feel so inaccessible and off limits. And so because I went into it a little bit later in my career, I wasn't really born into finance. I feel like I was able to develop a way of communicating about it and speaking about it that hopefully makes it more accessible, because it is. And that's why it's so amazing, Ben and Chad, that you're doing this wealth series and you're making it just more available and accessible, because it doesn't need to be just for a small percentage of the population in New York. Really, all of us can wrap our arms around this.
Oh, I love it. So the reason I asked that really bizarre question is you're really, really good at what you do. And I haven't met with a lot of females in your industry. And I think there should be an enormously large amount more. How you care about me and our wealth and our strategy and how you communicate is second to none. And I want the little Avas of the world and these other people listening to the Wealth Series to think maybe I should do what Molly does and maybe I should be in wealth management someday. So that is why I asked that question. And I hope some of the kids listening say, hey, I want to help people do this. Chad, any final thoughts or takeaways?
Takeaways? Yeah, too many, Ben, to mention here. Here's the one takeaway I'll narrow it down to. Find a Molly, right? Because Molly, I kind of get a lot of these things, and some of these things I have no clue on, and some of these things I absolutely understand. But some of the things you were talking about, even if I understood them even better, I still know that I would never do them on my own because of the effort that would go into it. So having somebody like Molly in your corner is going to give you that opportunity to really succeed. So find a financial advisor. Some of these things we can do on our own. And when we're doing the Wealth Series, folks, we're attempting to give you some of those simple things like we've talked about, opening your IRAs, things, 401k, all that kind of stuff. But some of these advanced strategies, get somebody in your corner.
I love that. Molly, thank you for being my person and helping protect my legacy and my wealth and my retirement and helping us on the journey and taking care of everybody that's always in our audiences. You're so good on stage and you contribute to us in so many ways. So thanks for being here today.
That's so nice of you. So happy to be here. Thanks for being you. And thanks for bringing me into these conversations and introducing me to your incredible network. I appreciate it.
Our pleasure.
Bob, Chad, if you could think of one word right now, what would it be?
I don't know.
That is not a word. Bob Stewart.
I got one. Supercalifragilisticexpialidocious.
I don't know. It's just there's a lot there, right? Like I'm a little bit. It's a lot.
It's always a lot to take in.
I thought one of you were going to say hippopotamus or something.
Nice job, Ben Kinney. Check that off our list.
Everybody, you can just imagine the amount of knowledge that's hidden in Molly's head, and we've only touched a small little percentage of it. So thank you, Molly, for spending all that time with us and being a part of the Wealth Series, Part 2.0, Part 2, etc. Chad, everybody needs to download the workbooks.
Yes.
Join the Facebook group.
Win, make, give.
If you're going to take advantage of the $10,000 and all the other prizes that we're giving away here, you're going to have to sign up and be a part of the Wealth Series, winmakegive.com/wealth.
Yes.
Follow all these other directions, which Chad's going to give you right now.
And there I go then. Okay, so yes, you have to go register at winmakegive.com/wealth. You've got to be enrolled in the system. Then just before we do the live call, no, we don't have a date on that yet. It's coming to you soon. Before we do the live call, you're going to have to fill out a Google form that's going to have all the giveaway answers that you have been collecting. That will make you eligible. Here's the thing. You don't have to be present to win. You have to have the homework done, though, to be eligible to win. And make sure you've enrolled in the program. Come join us in the Facebook group. Some people are asking amazing questions. Some people are sharing amazing takeaways. We want you to be doing the same thing because Ben, Bob, and I are here to help you. Folks, until our next episode, as always, do good.